Welcome, everyone. We'll get started in a few minutes. We are curious about how experienced you all are with 1031 exchanges. So if you wanted to share in the chat some of your experiences, maybe rate it on a scale of 1 to 10, 10 being extremely experienced, 1 being new to 1031 exchanges. This will help us tailor our content going forward and make sure that this is a valuable learning series for you. And I'm also curious, I always love to know where people are joining from. So if you want to pop that in the chat too, we'd love to know where you're virtually joining us from. I'm here in Chapel Hill in our headquarters. And Matt, where are you joining from?
I'm joining from the big city of Pilot Mountain, North Carolina, from the basement of the Linville home.
Excellent.
We can do these anywhere, right, Jennifer?
That's true. Got someone in Chapel Hill here with me. It's so far a pretty nice day in Chapel Hill. A little warm. We'll just give everybody a couple more minutes and then we'll dive in here. Thank you for your patience so far. All right, should we go ahead and kick off, Matt?
Let's go.
Okay. So everyone, welcome to what is the first in our new webinar series that we are calling Exchange Connect. I'm Jennifer and I'm with Investors Title Exchange Corporation. We also shorten it as ITEC, so you'll probably hear us refer to that as well. For over 38 years, ITEC has served as a qualified intermediary in 1031 exchanges. This is a free learning series. Throughout it, we'll be sharing insights into 1031 exchanges and real estate investing. Some of the topics that we will be covering and discussing include forward and reverse exchanges, different asset classes like Delaware Statutory trusts, seller financing and depreciation, as well as dispelling some common myths about the 1031 exchange, because we hear a few of those out in the world. So we want to make sure that you have accurate information. We will be joined by additional experts, including realtors, attorneys, lenders, and financial planners, so that we can help you navigate exchanges with confidence. Before we dive in, we do have a couple of quick housekeeping items. If you have questions throughout today's webinar, please feel free to type them in the chat and we'll do our best to answer them. We'll also send you a copy of this recording in case you want to rewatch it or you want to share it with others. I also have a quick disclaimer before we begin. The information that we're sharing today is not intended as tax or legal advice. So if you're interested in doing an exchange or you have a client who is, we always encourage people to talk with an attorney or a CPA before they decide to enter into one of these transactions. Now some introductions. I mentioned I'm Jennifer Gardner. I lead the marketing strategy here at ITEC. I'm also a realtor in North Carolina, and I'm very new to the world of 1031 exchanges. I joined the team in October. So I'm going to be learning right along with you, which means that I will also be joined by people with a lot more experience in 1031 exchanges. And today I have Matt Linville here. Matt, could you introduce yourself to our audience?
I'd be glad to. Hello, everybody. My name is Matt Linville. I have the great pleasure of serving as Vice President of Business Development for Investors Title Exchange Corporation. Uh, I spend my days, most of it, traveling around and about, delivering continuing education and continuing legal education, talking 1031s to everybody that I possibly can. And Jennifer, if I can say this, somebody told me this yesterday, I thought it was wonderful. On all my report cards when I was a kid, the teachers used to write in, Matt talks too much in class. And now I think that's a virtue. So I love talking to anybody I can about the benefits of a 1031 like kind exchange. The great thing is I actually get to do this for a job with one of the most wonderful corporation, one of the most wonderful companies in the country. So I'm privileged by all means.
Excellent. Well, I know there are a lot of people on the team who have a true passion for the 1031 exchange, and we'll be talking to some of those later on in the series, including Victoria Templeton, who leads our team. She's going to talk to us about reverse exchanges next month, so that should be an interesting session. All right, so Matt, we probably have a few people here who aren't as familiar with 1031 exchanges. Can you tell us a little bit about what they are and when someone would use one?
Sure, Jennifer. So a 1031 like-kind exchange, I think, is one of the greater gifts the IRS has provided for taxpayers who own real property held for business or investment use. So it's simply put, it's a provision in the tax code that allows a real estate investor to sell an investment property, defer the tax on the gain they would normally have to pay the IRS as long as they reinvest the proceeds from that sale into another like-kind property within some very specific time limits. So the name itself comes from Section 1031 of the Internal Revenue Code. It's been around in one form or another, and this kind of amazes people. It's been around since 1921, so it's well over 100 years old. And I say that because I want people to know that a 1031 is not a loophole, it's not a workaround, it's actually tax law, and it was designed specifically to encourage investment or continued investment into real estate. And if we're kind of talking about when we might want to use them, what we would typically see, Jennifer, is when an investor wants to sell, but they don't want to pay the tax bill. Like that's the number one piece. That might be an investor who's tired of managing property and they want something much more passive. Maybe they want to consolidate multiple properties or divest from one big property into several multiple properties, moving equity from one market to another. But the common thread, I think, throughout all of these taxpayers is they want to make sure they keep their capital working instead of writing a check over to the IRS.
Right. Why do you think the IRS allows us to do this?
Well, Jennifer, they're just kind. I mean, what other reason is there other than the IRS really cares about us? I think that, again, it's that continuous investment into real estate. Listen, that is a benefit to our nation, and take that down the multiple levels that you can go down to the small town where we're
Mhm.
talking about real investment from commercial to residential investment property, causing housing to be created,
Mhm.
jobs are created, economies are built up, partly through this 1031 like-kind exchange and that investment and growing of commercial and residential property.
Mhm. So, for someone who's entering into the world of 1031 exchanges and decides to do an exchange, what are some additional benefits beyond deferring those taxes?
So, well, I mean, listen, deferring the tax is the big one without any question. But if we can put some numbers around that real quick, just to make sure that why that's the big piece is, let's say you have a real estate investor who's selling an appreciated property, and out of the four taxes that they may have to pay on that sale, you're looking at about 25 to 35% of the gain being paid in tax. So on a property
Mhm.
with, let's say, a $500,000 gain, that's potentially, between $125,000 and $175,000 that's walking out of the door before they ever reinvest a dollar of that. Now,
Mhm.
that's a general idea, but that's kind of the power that we're talking about. So outside of that, again, let's think about portfolio repositioning. So since we can trade one type of property for another, um, and I can explain it the way I hear it a lot. We're taking a tired apartment building and we're selling it and exchanging it into a triple net commercial property. Again, multiple properties into one. We actually get to keep some geographic flexibility when it
Mhm.
comes to this 1031. So that means that I can sell in one state and I can move over to another. And maybe that's important because the market is shifting, or guess what? The family's picking up ties and we're moving to another state
Mhm.
and we want our investment property to chase us. And then
Mhm.
lastly, one of the big reasons I think is estate planning. So if we have somebody that is exchanging and they hold that replacement property until death, then there's a great possibility if it stays in place that the heirs could actually inherit a piece of property and get a step up in basis when they inherit it. And all that tax that was deferred from the decedent's real estate holdings basically goes away. So again,
Mhm.
those are all tedious examples that need to be talked about with a real estate attorney, tax attorney, CPA, but those are some other reasons that kind of join in that greater idea of deferring the tax and keeping that money
Mhm.
reinvested and working.
You mentioned that I could do an exchange in another state. I imagine investors occasionally will say, we see this great economic opportunity in North Carolina, for example,
Yeah.
and I might live in Texas, but hey, I really want to be part of that growth in North Carolina. I would imagine that would be another opportunity that you could use an exchange for.
Absolutely. And Jennifer, what would we say? Come on. Come on to North Carolina. That's exactly right. So again, those things take great coordination between, who is going to be your real estate representative in each state? Who do you trust to work with? Who are you working with who understands 1031s and the timeframes I know we're going to talk about? But you're exactly right. I'm looking at high growth areas or what will be a high growth area in 5 to 10 years.
Mhm.
And the 1031 can provide some flexibility to get that property sold, retain the tax again that they normally have to pay so that they
Mhm.
have more money to reinvest into those key areas.
Right. So who's typically involved in these transactions? I imagine, I would want my CPA or my tax attorney. Who else do I
Yeah.
need on my team?
So I would say there's four parties really. Of course, we're going to have our client, the taxpayer, the exchanger, that's the investor, whether it's a person or entity that's selling and buying the property. We're going to have the qualified intermediary. Now that's our role at ITEC, and we hold the proceeds between the sale and the purchase of the property. And we'll talk about it, I know, because the investor cannot touch that money. That's a very hard and fast rule. But we help facilitate the exchange, prepare the exchange documents, make sure the mechanics are done correctly. So that's two. Third, we're going to have our real estate professional, Jennifer, and that is our residential agents, our commercial brokers on both sides of the deal. And one of the reasons that we love them so much is that very often, for those agents and brokers who are on the webinar with us right now, sometimes you're the first person that may recognize that a 1031 is appropriate for this pending transaction. So not only are you key to the deal from the sale
Mhm.
standpoint, but also helping recognize what's possible with the client. Um, Fourth, as you so aptly said, Jennifer, we have the advisors involved. That's
Mhm.
CPAs, attorneys, financial planners. They're making sure and helping that investor understand the full picture. And that's the
Mhm.
picture that maybe the broker or agent doesn't see. Is the full tax picture that the qualified intermediary is not necessarily going to see, but they're crucial because they understand exactly what the taxable situation is for that
Mhm.
taxpayer. If they have some losses or things that may eat up some of that gain, to help determine whether or not a 1031 is perfect or necessary for their situation. So I would say everyone has a role. The QI doesn't give tax advice. The CPA is not going to hold the funds. So knowing our lanes in the 1031 like kind exchange between those involved really, really matters.
Mhm. And for those of us who are a little bit new to this area, why do I need a QI?
So well, the IRS requires it. That's why, but they do require it uh, when you have a delayed exchange, meaning you're a taxpayer selling to an entity and you're buying from a different entity, and there's a delay in between those transactions, which would cause somebody to need to hold the money.
Mhm.
That's when the qualified intermediary is absolutely necessary. So when you sell the 1031 property, you cannot receive the proceeds as a taxpayer. I mean, if that money hits their bank account, if they have constructive receipt of those
Mhm.
funds, the exchange is over, period. So the tax code requires a qualified intermediary to hold those funds in between. Now, in our role, we prepare the exchange agreement, we coordinate with the closing attorneys or title companies, make sure the timeline is documented properly, and we'll talk about the 45 and 180 days. But those are crucial because you miss one and you've got a taxable sale. I mean, that's
Mhm.
simply what's going to happen. So unlike a lot of things in real estate, it's not a DIY situation when it comes to the 1031. So in general, your attorney can't serve as the QI, the real estate agent can't serve as the QI, your related party, whether that be family or from a business situation, they can't act as your QI. They truly need to be a qualified, independent third party. But I'll go back and say it best, Jennifer. The IRS requires it for most transactions.
Sure. And, in my experience, they're often complex transactions. So you do need an expert. And, our team, we have a number of people with a designation, a certified exchange specialist. And I know, Matt, you're one of those people.
Yes.
Um, Maybe tell us a little bit about that.
Sure. As you said, the certified exchange specialist is the only designation that we can get in the 1031 world. It's administered by the Federation of Exchange Accommodators, which is kind of our trade organization. And what it means is we have a certain amount of experience within the 1031 field of work. We have done so for an X amount of years. We take and pass a very, very difficult test, and we have to keep up with continuing education every year. And I think all of those things greatly benefit real estate investors and all those who may work with a qualified intermediary because there's a way to make sure that they're working with well qualified, up to date qualified intermediaries. And I think that CES designation, Jennifer, is very, very important for those who are out there kind of shopping what qualified intermediary they may or may not want to use.
Mhm. And I know timing is a big issue here in this 1031 exchange, and
Yes.
you want somebody who's going to really keep you on schedule. So, can you talk a little bit about what those deadlines are?
Yeah. So Jennifer, if I can say it now, I know you're starting out in the real estate world, and I know we have a couple of very, very experienced commercial brokers and real estate folks on the webinar with us. And so I think I can say this. Um, you will never have a client who's ever anxious or nervous or who's going to text you, email, call you all the time, wanting to know what's going on. I mean, that's never going to happen, right? So I would say that when we're looking at a 1031, you might have a client who is a little more anxious and a little more determined to get your help and your input when they are looking at selling and or buying property. And these, if I can say, artificial timelines that are placed on the client's transactions simply because they're choosing a 1031 are hard and fast. There's two, and they both begin to tick, Jennifer, at the sale of the relinquished property. And those two clocks first are the 45-day identification period, and the
Mhm.
second is the 180-day exchange period. And this is what the IRS says. We have, as a taxpayer, they have 45 days to actually identify property or properties they may want to purchase as replacement property in their 1031. Now, signed, dated, turned in typically to the qualified intermediary, specific to the property they want to buy, no ambiguity in there.
Mhm.
So that's time clock number one. Why is that important? Well, number one, let's increase the anxiety just a little bit. Those are 45 calendar days. So not business days, but calendar days. So Saturdays, Sundays, rainy day Mondays, we're on vacation. We just don't feel like it kind of days. They all count in that 45-day calculation. So if I'm a taxpayer and I'm working with a broker or agent, I want them to know my pain point. I want them to know that I only have 45 days to identify property that I may be able to purchase, hopefully so, to complete my 1031. So that is a bit of added pressure and a timeline that they don't have in a normal sale and purchase outside of a 1031. The second overall time frame, Jennifer, is the 180-day exchange period. And what the IRS says is taxpayer has 180 days, again, from the day they sold their piece of property, to actually close and take title to any or all of the property that they identified within that 45-day period. Now, I know somebody may go, wait a minute. Now, so let me be specific with what the IRS says. What the IRS actually says is the taxpayer has 180 days or until their tax filing due date, whichever one is less. Okay, so that's very exacting.
Mhm.
But again, that means they have to actually get the property they identified, They have to underwrite it. They have to make sure, walk in it, make sure they want to buy it, make sure it's something they want to own, make sure they can get a loan on it if necessary. So there's a lot of normal working parts that have to take place. And again, we're putting an artificial timeline of 180 days to get all of that done. So yes, Jennifer, some of your clients are going to be more anxious than others.
Sure. It
Yeah,
sounds like a lot of time, but it's really not a lot of time
right.
when you think about a real estate transaction. So I know you and I talked the other day about how you might strategize and start finding those properties before you even sell the property that you want to relinquish.
Yeah, I give a great example. And when I'm talking with agents and brokers and say, okay, what if I just called you out of the blue? Okay, you don't know who I am. We're looking at doing a 1031, but the only thing I say to you, Jennifer, when I call you is I'm on day 43. Like that's it. Not, hey, I'm mad, I'm looking for this. All I say is I'm on day 43. Then hopefully your response to me, Jennifer, is nothing less than, what do you mean you're on day 43? You got 2 days left. What have you done with your 43? Is this a good number for you? What's your email? Where are you? What are you looking for? How much money do you have to spend? Like these are the questions that should just kind of roll off your tongue when you begin to talk to them. The earlier you talk to your real estate professional, the
Mhm.
earlier you talk to your tax professional, the earlier you talk to your qualified intermediary, the better. Can we do things last minute? Absolutely. Does that leave us enough time to make sure some of the things that need to be done for 1031 purposes can get done? Maybe, maybe not. But the most well-prepared taxpayers that we deal with are the ones who take the time, treat themselves kindly, and talk to the important advisors in their life and begin that discussion with a qualified intermediary as soon as they begin thinking about
Mhm.
selling. So I think that's it. And if I were an agent or a broker, man, I want to have access to them as early as possible so that we can find out exactly what they want, exactly where they
Mhm.
want it, how much money they have to spend, and help find them maybe even multiple properties that they can ID and potentially close on, Jennifer.
So what if I miss one of those deadlines? What happens?
I'm not going to say it's going to be weeping and gnashing of teeth, but let's say, if they miss a 45-day deadline, Jennifer, and whether that's unintentionally or purposefully, okay? So if they do not have any property identified in writing, signed and dated to the qualified intermediary by midnight of day 45, whether that's they simply didn't turn anything in or they in writing revoked anything they have identified in the past, if they clear midnight of day 45 without any property identified, day 46, their exchange is over with. The qualified intermediary is going to return the proceeds back to them if they truly have nothing identified by midnight of day 45, and it'll be taxable to them just as if they never tried to complete a 1031.
Sure. So we had in the chat, someone would like you to just reiterate the timing and the deadlines that we have to adhere to in one of these transactions.
Sure. Yeah. Again, two clocks both begin to tick the day that the relinquished or the property that the taxpayer is selling closes, the 45-day identification period. The taxpayer has 45 calendar days to identify property or properties they would possibly like to close on for their 1031. So that's our 45 days. And then
Mhm.
again, 180-day clock from the time that they sold their piece of property, 180 days, which isn't always 6 months. Okay. That's why we say
Mhm.
180 days to actually close and take title to any or all of the property that they identified within those 45 days.
And that's calendar days, no
Yes.
exceptions, um, or very rare that we'll
Very
have an
rare.
exception.
Yeah, very rare. And so when it comes to identifying properties, I give it, let's think about it this way. You have a client who says, I want to identify property A as my replacement property. It's the only one I'm going to identify, Jennifer. That's it. Okay. Perfectly fine. 45-day period goes through. We
Mhm.
chisel that property A in stone because that's the only property that they can buy and get any tax deferral benefit through this 1031 because that's the only one they identified. On day 47, they walk into it and they look at it and go, there's no way we're buying this. or on day 50, the property falls off the market for the million reasons that it can. Well, if they haven't identified any other property and they can't close on that property, whether by intention or by non-intention, the IRS has no heart for that. They really don't. There's no extension period for them. The only time, Jennifer, we have an extension is if we have a presidentially declared disaster, and that's county by county. And again, that's something we don't want to have happen to get that
Right.
extension. So be prepared. Make sure that you understand the 45 and 180 days. Make sure you're working with people who also understand those 45 and
Mhm.
180 days. Those are deadlines you do not want to miss if you want to keep your tax deferral in place.
And the other thing I think it's important to remember too is that you really should put this process in motion before you get to the closing table.
Yes, I very much agree with that. So we would say, if you do not have a signed and dated exchange agreement with a qualified intermediary in place by the closing table, there is no 1031.
Mhm.
So yes, that the necessity of working with a qualified intermediary is there. And that's why we would suggest find out who you want to work with and go ahead and call them, build that relationship, ask the questions that you can. I promise you, the qualified intermediary is going to answer the things that we can. We're going to default on the things we can't. We're going to push you back to your CPA, accountant, tax advisor to make sure you're getting the best advice possible. And we'll be there with you. And if somebody's going to hold my money, Jennifer, I kind of want to talk to them ahead of time anyway.
I agree with
Yeah,
that.
just the way I feel about it.
Yeah, and I want
But
to know that that money is going to be secure.
yes, by all means.
Um, and speaking of money, do I have, does this have to be a large amount of money that I'm does my property have to be a certain amount? Or can I exchange something that isn't high in value?
No. And I think this is a great way of looking at it, Jennifer. I think it is a misconception. So there's no, from the IRS perspective, there's no statutory minimum to do a 1031 exchange. So none at all. I think if the tax deferral makes economic sense relative to the
Mhm.
cost of doing the exchange, then it's worth considering. I mean, regardless of the property size. So, you know, the qualified intermediary fees are typically flat, and at ITEC they're modest and they're fixed. So the question really isn't, is my property big enough? The question is going to default back to, what is my potential tax exposure? So if somebody's facing a $30,000 capital gain from the sale of a piece of property and the exchange costs are just a fraction of that, they don't have any losses or anything else to help offset that gain, then it would seem that the math is pretty straightforward. So we've
Mhm.
certainly seen exchanges on very small lots of land for just a few $1,000s, and we've seen portfolios worth hundreds of millions. The
Mhm.
great thing is the rule is all the same and the opportunity is the same. It's just a matter of whether that number that they can potentially defer is big enough for them to take on the opportunity cost of a 1031 like kind exchange.
Mhm. So we know it has to be real property, right, that
Mhm.
we're exchanging.
Yes.
Does it matter, what kind of property I exchange for the new property? Is that something that I have to consider?
Um, I mean, it is something you have to consider. So I guess that what we get a lot of is, okay, Matt, sorry, I use my hands too much. I almost knocked my laptop off. Okay, so I guess most people would say, well, Matt, there's a like kind definition. And I know, and these are the calls I love, I know that if I'm selling a single family home, I have to buy another single family home to make sure it stays like kind. And the great thing that we get to say to them is, you know what? That's possible. However, your possibilities are much more broad than that.
Mhm.
So let's go back to the base definition, which is any real property is like kind to any other real property as long as it's held for the right use, being business or investment use. So, to your
Mhm.
point, Jennifer, I can sell land in California and I can buy multifamily property in North Carolina. I can sell that multifamily property in North Carolina, buy an Amazon warehouse in Illinois, sell the
Mhm.
Illinois warehouse, and I can go buy a portfolio of single family rental properties down in Texas. So as long as it's considered real property and as long as it's held for the right use, Jennifer, it's going to be considered like kind. Now, The reason I think that's so important from an education standpoint, if we're not educating, and I mean all of us on this call, if we're not educating our clients, those folks who are owning real estate, and they truly believe that I have to sell a single family rental and buy a single family rental, maybe they don't think about a 1031 at all because
Right.
that's not the asset class they're wanting to go into. So all of a sudden we bring them the truth, we expand their opportunities, and then maybe a 1031 is something they begin to look at seriously because, oh, if I don't have to go back into that time trash toilet court crying at the dining room table kind of property and I can go into
Mhm.
something else, then maybe a 1031 is fantastic for me.
Right. It's a way to, you know, take your investment from one asset class and put it in a different asset class if that's something you're interested in doing. I know we do hear a lot, well, I'm selling land, I've got to buy land. And well,
Mhm.
no, that's not really the case. And we've had some interesting things that people want to buy in their exchange, just like
Mhm.
boat slips. I never would have thought that that was real property, but
Yeah.
it in fact is. So it's really a fascinating world that we're operating in here at
Absolutely.
ITEC.
It's a fascinating world. We deal with fascinating people who are doing and making fascinating transactions take place. And so listen, this is a professional passion of mine. Jennifer, I know it's going to grow to be yours. The team that I work with, it's their professional passion. It is such a wonderful thing to help people, whatever transaction they're working on, keep all of that equity that they have. There's a great term about sweat equity. When you're able to put a sweat equity into your own deal, that's what we're doing. All of that sweat and tears and blood that people put into their real estate investments, we get to be the fortunate ones to help them defer that and get bigger and better when it comes to their real estate portfolio. And I just think that's thrilling.
And I know it can also be part of your estate planning. Can you talk a little bit about the benefits there?
Yeah. So again, one of the things that we don't want to talk a lot about is death, and I get that, but
Mhm.
death is inevitable, and certainly when it comes to taxes and real estate, if real estate is one of the main ways that someone wants to pass along wealth to the next generation, then I think a 1031 should be a part of the conversation. I'm not saying
Mhm.
it's the answer, but it should be a part of the conversation, meaning, again, since that taxpayer gets to defer the amount of tax that they would have to pay on the sale of real estate, and they can continue to defer. Now, we say it, whether you do one exchange in your life or you daisy chain 20 exchanges together in your lifetime, you can continually defer and reinvest and reinvest and reinvest. But what happens when we die? Well, now we do have some state cap issues, et cetera. But one of the main components is that step up in basis for the heirs. And if that remains for us, think about it this way. As myself, I've been able to buy real estate, do 1031s, defer all that tax, reinvest. Now I die.
Mhm.
Guess what goes in the coffin with me? Well, all those taxes that I deferred. And my children get a step up in basis to the fair market value of the
Mhm.
property or properties when I died. And so, what a great way. Again, listen, all these things can change, but right now that step up in basis remains. 1031 remains in full effect. And if I am talking with somebody or if I myself are looking at estate planning, this is one of the things I'm talking about if I own real estate as part of
Mhm.
my wealth buildup.
Right. Well, this is really fascinating. I know, Matt, you and I could go on for hours talking
Yeah.
about the intricacies of 1031
Yeah.
exchanges.
I don't think
And
anybody else would like that, but yes, I would. Yes.
I encourage people, if they do have questions when we're done here today, to reach out to you. You're always happy to talk about this. As you mentioned, it is your passion. But let's turn to a couple of the questions in our chat. Someone has a question. They own apartment properties and they're wondering if to utilize a 1031 exchange, can they build an apartment property and that would work? Does it have to be around the same amount of units or value? So I'll let you take that question.
Yeah, so let's talk about the value question. Value is very important. So let's say you're selling this property for $1 million. You want to
Mhm.
defer all the tax from that sale. What the IRS would say per their napkin rules is if you sell for $1 million, then you need to buy a property or properties worth at least $1 million. Okay.
Mhm.
Debt plays into that, absolutely, but we're looking at, a million for a million.
Mhm.
Talking about building, talking about improvements. Now, I know Victoria Templeton is going to come on and she's going to do the most amazing job talking about reverse exchanges, and part of that's going to be improvement exchanges. Now, here's one of the things that the IRS says. You cannot use 1031 money to improve or pay off property for which you're already in the line of title. So if you think about it from this
Mhm.
aspect, if I'm selling property A, multifamily, I'm buying property B, land in which I want to develop multifamily. If I go and buy property B and I hold it, then I can't use any remaining 1031 money to actually make those improvements on that land and it count in a tax deferred standpoint. So what you need is actually kind of that third party, and that is the exchange accommodation title holder, which is also a part that we play, who actually comes in, buys it for you with a loan from the taxpayer or a bank. The money's necessary. We buy it, we can hold it, triple net lease it back to the taxpayer. They can make as much in the way of real property improvements as possible within the 180 days. So again, that's kind of the reverse improvement exchange. It's possible. It's a little more detailed and specific, but we would love to talk to you about that and make sure you have all the details of how that works.
Mhm. Yeah, I know it is a little bit more complex than a straightforward 1031 exchange,
Mhm.
but we do handle both types of transactions.
Yes.
And let's go back to the deadlines again. I know it is complex, right? The timeline is a little bit complex. And so, tax time can impact whether you get 180 days. Tell us about that.
So let's think about a client who is selling a piece of property in December and their tax file December of 26, and
Hmm.
their tax filing due date is April 15th. Okay. So what the IRS would say is, since you have to report the sale of a property in the taxable year in which it was sold, then I have to complete my 1031 so that I can report it on my 2026 taxes, which means if I sold in December, my actual 1031 deadline would be April 15th, which is short of the 180-day period. Now, I'm not going to say it's a workaround, but some of our clients will certainly talk with their CPA or accountant. They will file an extension and push that tax filing due date back so they can make sure to have the full 180 days. But again, remember that 180-day rule,
Hmm.
180 days or until your tax filing due date, whichever one is less. It's important, especially from September, October, when you have
Hmm.
LLCs or other entities that may file in March, you have others who are going to file in April, to make sure that the qualified intermediary and their advisors are steadfast and steady in the way that they
Hmm.
count that 180-day period and remind them.
Yeah, this is just another reason I think that you need a really trusted, knowledgeable team when you enter into
Absolutely.
one of these exchanges.
I'll never disagree with that, Jennifer.
So, what are some strategies that as advisors, whether we're, a CPA, a financial planner, a realtor, what are some strategies we can use to best support our clients?
Well, I think building relationships is number one.
Mhm.
I think if I were a CPA or an attorney, I would want to make sure that I had a trusted, qualified intermediary that I could make a confident referral to for a client.
Mhm.
Knowing that the attorney and CPA have certainly the ability to give the tax and legal advice, but may not have the ability to serve as the qualified intermediary for them, and may not want to if they could. So have somebody that's trusted, who you know is safeguarding funds, who is going to call you
Mhm.
back, responsive to emails. They understand what they've doing. They've been in the QI industry for a long
Mhm.
time. So again, who do you trust? Second, I would make sure that this education is available for all of my clients,
Mhm.
whether or not they've talked to me about a 1031. If I can send information out to them, if I know they own real estate, what is and I hate to say the word marketing to them, but that's exactly what it is. I want to market great
Mhm.
information to my clients so that when they do have that thought of selling property, they know to call their CPA or tax attorney, or make sure they're saying this to their agent or broker. Gosh, I'm really thinking about a 1031 for this sale. Um, I think that's simply it, Jennifer. having that QI at the ready and informing your clients whether or not they've mentioned a 1031 or not. These are the basics. Here's this. Call me with questions. I can hook you up with the right qualified intermediary because time frames matter. Having the QI in place matters. If you want it to happen, it can't happen without us involved.
Right. So selfishly, as a broker, what questions would I want to be asking my clients if I wanted to uncover a 1031 exchange? Because there is opportunity here for me as a broker, right? I could potentially help them on multiple transactions.
Yes, I'd listen. I'd one of the questions that I want to know is when you're selling this piece of property, are you going to have a large gain?
Hmm.
I think that's number one. Not everybody who sells investment property, Jennifer, is a true real estate investor. And, I mean, you have people who inherit land, they inherit
Hmm.
rental property, or they inherited mom and dad's house, and they just didn't have the heart to sell it. And they
Hmm.
began to rent it out to people that they knew. And now all of a sudden they're facing a sale and a tax that they're not even really thinking about.
Hmm.
Um, Second question is, what is your continuity plan? What is your investment plan? What are you going to do with these funds? If it is, well, gosh, we're thinking about going into other real estate and we have a taxable gain. Okay, a 1031 is something we should talk about.
Hmm.
Um, I mean, I think those are the basics that get the conversation started.
Hmm.
It doesn't take much. All you have to do is say something about tax and it gets people's attention. Or, hey, you don't want to pay tax right now, or maybe never, then let's talk about 1031.
Right,
Yeah,
right. And we're going to be talking to experts about different kinds of asset classes, which should be pretty fascinating. Delaware Statutory Trust comes to mind because not
yeah,
everybody wants the three T's, the tenants, the toilets, and the trash. But maybe they want to diversify their portfolio and have that real estate holding.
that's exactly right.
Well, great. I've learned something. Every time I have one of these conversations, I learn a little bit more and it strengthens my knowledge around like kind exchanges. So Matt, thank you for all of um, your expertise and your passion for this space. And I look forward to having more conversations with you and with other experts. And I hope everyone will join us. Please feel free to reach out to us if you have questions about 1031 exchanges that we can help you with. It is very nuanced. So we're here to support you and help you develop your expertise in this
That's
space.
right. Let me say one closing statement, Jennifer. Clients remember who educated them and who helped them keep more of their money.
Right. And who doesn't like to keep more of their money?
Agreed.
On that note, thank you everyone for joining us for this first webinar in our new series, Exchange Connect. Look for more information from us. As I mentioned, Victoria Templeton will be talking about reverse exchanges. So lots of great information to come. And thank you again for being here.
Thank you, everybody. Umberto, Mr. Salazar, how are you, sir?
Let me un-
Oh, you're still on mute.
How about now?
There you are. How are you, my friend?
Man, I hope you're in North Carolina.